Aloha, inspired moneymakers. Welcome to Inspired Money, the show where we strive to do more with our money. We want to make more, give more, and live more. I mean, what is money if we cannot enjoy it or have a positive impact? Today, we're talking about alternative asset classes. That means investing beyond stocks and bonds. Conventional wisdom says that diversification is good. I'm sure that you've heard the phrase, don't put all your eggs in one basket, right? Besides spreading the risk, alternative asset classes aim to provide non-correlated investment returns. That means when stocks go down, hopefully another asset class is going to go up or stand still. Over time, this can reduce volatility in your investment portfolio. In this episode, we're going to discuss tangible assets like gold and art, digital assets like cryptocurrencies and NFTs, the smart money of hedge funds and private equity. Join us as we explore the complexities and opportunities that these alternative assets can bring. Stay tuned for insights, strategies, and a fresh perspective that just might transform the way you view investing. We've got a stellar panel to guide us. Each is accomplished in his field. And best of all, I think that we have a group of individuals who can explain things very clearly so that it's easy to understand. Let's welcome them in. Welcome, everybody. We've got Gary Brode, managing partner at Deep Knowledge Investing. He delivers independent stock ideas and market research to sophisticated investors. His career spans M&A and portfolio manager roles at Morgan Stanley, Seneca Capital, Brahmin Capital, John Levin and Company, and founding ventures like Akita Capital Management and Silver Arrow. Gary, you have over 31 years experience working at large hedge funds and running your own hedge funds. You run a research service that includes macro hedging and stock picking. What is it that you love about investing?
I wake up, first of all, Andy, thank you so much for having me. I'm glad to be here. But I wake up every day and get to spend time learning about some of the best businesses in the world. And the thing that I love more than anything else is you see, usually a stock has a certain narrative. There's a story that people are following about it. And, you know, when you start to do the work on it, you can get a day in, 2 days in, a week in. And sometimes you have that moment when you realize, wait a minute, everybody's looking in the wrong place. They're all viewing this wrong. And that's when you realize you have a different thesis than everyone else. You have an alternative point of view. And that's really where you make a lot of money, whether it's on the long side or the short side. It's that moment when you realize that you have a different view than everybody else and you know your work is right and you have the opportunity for outsized returns in that moment. And that's really fun.
I look forward to talking more about that and getting your insights. Ric Edelman is back on Inspired Money. He's a #1 New York Times bestselling author of 12 books on personal finance, including The Truth About Crypto. He hosts the Truth About Your Future podcast and was host of the country's longest running radio show on personal finance. He's founder of the nation's largest financial planning firm. He's been recognized in research magazines and Barron's Financial Advisor Hall of Fame. Check him out in episode 273 of Inspired Money last August, where he talked about longevity, wealth, and the future of AI. Ric, how excited are you about the approval of spot Bitcoin ETFs?
Andy, it's great to be with you. Thanks for that kind intro. It's all really pretty exciting. This is considered the holy grail of crypto, and we are recognizing that it's been 10 years before we got to this point. Financial advisors have routinely said that they want to allocate to crypto for their client portfolios, but they haven't been able to because there hasn't been an ETF available. Now that it's here, we're already beginning to see in just the first couple of weeks, billions of dollars flowing into these ETFs. They are collectively the most successful ETF launch in history, and we're only just now getting started. We are expecting hundreds of billions of dollars to be flowing into these ETFs over the next 2 to 3, 4 years. And it's going to be really very exciting. It's great for wealth creation for the clients. It's great for practice management for the advisors. And it's really good for the overall economy. So we're excited about it.
Well, it's a ripe topic for today. We're talking about alternative assets and crypto. Certainly with ETFs, just the accessibility increased big time. Our next panelist is David Stein. He's former chief investment strategist at FEG Investment Advisors. He's co-founder of Asset Camp, a fintech platform of dynamic data-driven research tools focused on asset classes. With over 20 million downloads, his Money for the Rest of Us podcast guides self-directed investors through the challenges of securing a lasting retirement. David, you have a unique background as an institutional investor, a content creator, and entrepreneur. Money for the Rest of Us has a great mission. How did that come about?
Well, I found when I left the institutional asset management business and called myself retired for a year or so in my mid-40s that I missed the teaching aspect. I used to work with a lot of not-for-profits, endowments, foundation, universities, and so really launched Money for the Rest of Us as a way to continue that education mission, but focusing more on individual investors that frankly need help and are looking for someone that they could trust and understand investments in a way that isn't necessarily inside baseball, but just kind of understand the underlying principles that drive financial markets and the economy.
It's a big mission, since all the studies continuously support that people need more education in personal finance and managing their money. So kudos to you. I'm excited to have this group this evening. We were hoping and had scheduled Scott Lynn, founder and CEO of Masterworks. Unfortunately, he's under the weather, so he is not able to join us this evening. But we are going to talk about art and everything else. I'm looking forward to it. Let's jump right into segment one. In today's investment landscape, the allure of alternative assets is undeniable. As traditional portfolios evolve, savvy investors and institutions are turning towards a diverse range of options beyond stocks and bonds. From the tangible appeal of real estate and art to the digital intrigue of cryptocurrencies and NFTs, these assets are reshaping the concept of diversification. But why this shift? It's not just about seeking higher returns in an uncertain interest rate environment. It's about strategic portfolio enhancement. Alternative assets can offer unique benefits, acting as a hedge against market volatility and inflation, thereby reducing overall portfolio risk. However, this new territory comes with its own set of challenges. The complexity and due diligence required for these investments are higher, and liquidity can be a concern. As we navigate this evolving investment terrain, it's crucial to understand that alternative assets are not just about higher risks for potential higher rewards. They represent a fundamental shift in modern portfolio theory, offering new avenues for growth and stability. Rick, can you get us started? What are the benefits and risks of alternative assets compared to traditional assets?
Well, we have to recognize that the economic environment has radically changed. The financial services industry has evolved dramatically over the last 15 to 20 years. The traditional asset classes, of course, are stocks and bonds. The problem is that if you look at the number of stocks that are publicly traded in the United States, 15 years ago, there were 7,500 of them. Today, there's less than 3,000. It's kind of funny that the Russell 5000, the Wilshire 5000 index has only 3,000 stocks in it. Companies used to go public in order to raise capital to grow. So that doesn't happen anymore. Today, young companies get private equity. They get venture capital, angel investing, and PE funds. And when they go public, they're not raising capital, they're cashing out. And that presents a problem for investors who are looking for really good investment opportunities. I mean, you could invest in Microsoft at its IPO 40 years ago. Well, by the time Facebook did its IPO, it was already worth tens of billions of dollars. So this is forcing investors to look elsewhere, to seek alternative ways to enjoy the kinds of returns that are available in the economic marketplace. And that's why we need to pay attention to this asset class. and why institutional investors are doing this very extensively. Endowments, pension funds, insurance companies, sovereign wealth funds are all very heavily engaged in alternative investing, because these offer the opportunities that we used to traditionally get in the public stock markets, but really aren't there anymore. We also have technological innovation through fintech, not least of which is AI and blockchain and digital assets technologies, which are creating entirely new investment categories. We have the opportunity through tokenization, which is an outgrowth of blockchain technology, where we can demonetize and therefore democratize assets of any kind. You know, most people would agree that owning the Willis Tower in Chicago, the former Sears Tower, would be a pretty cool thing to own. The problem is it's worth $1.5 billion. There aren't very many people who can write that check. But if we tokenize it the way we tokenize companies, now we can take this $1 billion real estate and cut it down to tiny pieces of $10 each that anybody can afford to buy. So we have demonetized the asset. We have democratized the asset, and we have created inclusion. Anybody can now invest in what were highly expensive assets that are now liquid, that are now affordable, and now tradable on a daily basis. This is extraordinarily exciting. And so we're going to see the access of asset classes to every investor on the planet that previously were only available to the very wealthiest. And this is going to result in massive wealth creation on a global scale and an inclusion level that's going to help eliminate the inequities we have in wealth inequity and asset income inequity. That is going to help eliminate poverty on a global basis. So it's all extraordinarily exciting. And this is why alternatives are something that you really, really need to be paying attention to.
The world is changing very quickly. And certainly we've seen the Yale universities and Harvard endowment funds really leading the way, investing in alternatives through hedge funds and more illiquid investments. I want to ask David, what advice would you give to self-directed investors? Should they consider alternative assets, or should they keep things simple?
Well, it depends. So, if we actually were there with tokenization of the Sears Tower, it'd be much easier. The challenge with alternative investments, particularly the liquid ones, private equity, venture capital, things like that, is it is very much been driven by institutions, and access is key. There's these big institutions try for years to get into the best managers, and the range of returns within the alternative space is much wider than you see in the public market space. And so the way to successfully, let's say, private equity, venture capital, is you need many, many positions, and then some return 100, 1,000 times. And as individuals, even as there's more platforms to invest in, most individuals don't have the capital to spread out into the number of positions they need in order to benefit from some of the asset classes. Now, there's others that it's easier. Real estate's getting easier with some of the platforms. Certainly, individuals can participate in crypto. Art. There are more opportunities, but there's a long way to go to where, as an individual investor, we sort of have the same competitive landscape as institutional investors.
Yeah, I think David is absolutely right about that. What I've described is a future state more than it is in the current mode. The future is going to be very exciting. We need to be paying attention to this, but the notion of tokenization remains in its infancy, but the future is very bright. In the meantime, there are asset classes in the alternative space that are worth looking at, and we would consider this thematic investing today, where you can look at green energy, you can look at robotics, AI, fintech, ag tech, ed tech. There are dozens of ETFs available on the market today that allow you to thematically focus on these very specific narrow sectors that do provide you the liquidity. If there's a downside, it's the fact that they're only limited to investing in publicly traded companies, but it's better than nothing, quite frankly. And these investments, I think, could serve as the basis for an alternative sleeve in a diversified portfolio.
Gary, you come from a world of hedge funds where it's sophisticated investors, accredited investors. How do alternative assets fit into their broader investment strategy? And then can the average person get access?
I think it's difficult for the average person to get access. And, David and Rick, their responses on this question were very opportunistic. And I completely understand and agree with the idea of trying to make these assets available to a greater number of people. And my firm is set up to do that. But I think it's difficult. There are regulations that prevent hedge funds from taking on large numbers of clients, which means they need to take on clients with large accounts. The other thing I would add to this is I think too many advisors and mutual fund managers are really closet indexers, or worse. They'll put you in so many mutual funds that you basically own like the Morgan Stanley World Index, but with tons of fees. The other thing that I would add here is that alternative assets can give you different exposures, and the managers there are trying to outperform and largely have an incentive to outperform. And I know we hear a lot about diversification, but I think that's hugely overrated. Concentration based on great research is the way you make fantastic returns. From a mathematic point of view, once you're out past 15 or 20 positions, there really aren't statistically more benefits to diversifying. So better to own 10 or 15 or 20 positions where you have a great thesis and great research and you see things differently than other people. The other thing that I would add is I think so many people have fallen into this trap of we're in a good market or a bad market. If the market's going up, they're making money, they're happy. If the market's going down, they're unhappy, we're all losing money. And alternative asset managers might not just be asset gatherers. They'll focus on making money in any market. And the past few years have shown there are good reasons and good times to change your exposure rather than being 100% long all the time. One of our mantras at Deep Knowledge Investing is that we don't believe in good markets or bad markets. It is our job to find ways to make money no matter what the market position is or whatever the market situation is. You can always reduce your exposure. You can change your exposure. You can short things. There are always ways to take advantage of whatever the current situation is. And so I think when you have that kind of outlook and you're as opportunistic as Rick and David were just talking about, I think there's a great case to be made for alternative assets.
Great insights. Let's go to segment 2.
In the dynamic world of investing, cryptocurrencies and blockchain technology stand as the vanguard of innovation. Blockchain, the backbone of this revolution, is a decentralized ledger, bringing unparalleled security and transparency to digital transactions. It's the foundation upon which cryptocurrencies like Bitcoin and Ethereum are built, challenging traditional notions of currency and investment. They're not just another asset class. They represent a paradigm shift in how we perceive value and investment. Adding them to your portfolio could mean not just diversification, but also being part of a technological evolution. However, this new frontier is not without its challenges. The regulatory landscape is still forming, and security risks like hacking remain pertinent concerns. Yet the future is bright. With increasing mainstream adoption and continuous technological advancements, cryptocurrencies and blockchain are more than just investments. They're the harbingers of a digital financial era.
David, you mentioned before we went live that you've used Masterworks to invest in art. Can you share a little bit about your experience?
Yeah. In terms of art is another asset class, and but it's speculative. So Masterworks is a way to basically purchase a piece of art, like a very, very small piece. I've owned a Monet. I've invested through Masterworks. But the thing about something like art or Bitcoin or gold, there's no cash flow there. And so the returns is driven surely by demand. If you buy a piece of real estate, you have the cash flow from the rent and that. You can make money in real estate, even if the property doesn't go up in price. But with art, with crypto, it needs to go up in price because there's greater demand. And so some of the advancements, tokenization of art or the new Bitcoin ETFs, there is the potential to stoke more demand. But ultimately, those type of assets are a type of alternative assets that is speculation based. And by speculation is there isn't an agreement on what the right price should be. With something that generates a cash flow, a stock or a piece of real estate, we can get a valuation. Like, this is what it's worth. This is the PE. This is the price to cash flow, but not the capitalization rate for real estate, but not necessarily for art or for crypto. It's exciting areas, but at the end of the day, we don't want a huge portion of our portfolio. And for example, in my case, crypto, gold, art is less than 10% of my net worth. It's an important component, but it is not the workhorse of my portfolio. Those are cash flow generating assets, including some alternative assets.
Rick, you founded the Digital Assets Council of Financial Professionals. So I know in the next segment, we're going to talk about crypto, but I'm curious, like, what do you think the role of tangible assets like art or precious metals is in a technology-driven investment world? It feels like old world versus new world.
Well, there's something to be said for that, some legitimacy. I think David's on the money when he talks about the fact that this asset class, the alternative space, represents a minority position. Most folks who engage in alternatives will do from 5 to 30% of the portfolio. I think David's number at 10% is a good one, and that's for a broad-based allocation. Crypto specifically, my recommendation along the lines that David had said, that it's a speculative and uncertain asset class. My recommendation for crypto is 1%. And pretty much everybody who has studied this is in agreement that low single digits is the right number. Yale University did a study, they said 3.1. The CFA Institute did a study, they said 2.5 to 5. Everybody's pretty much in agreement that when it comes to crypto, you do low single-digit allocations for two reasons. Number one, we don't know what the future holds. This could blow up. A 1 or 2 or 3% allocation won't destroy your life. It'll be annoying, but not devastating. On the other hand, if it goes well, as some are predicting, with 5x, 10x, 30x asset appreciation potential, 1% goes a long way. You really don't need to have an outlandish position in order to have an outlandish impact on the portfolio. So low single digits in crypto is perfectly fine, and a minority position overall for your alternative space. And diversification helps to reduce the risks further. I think that's the real benefit of it, and why people are interested in this. Whether it's artwork, whether it's baseball cards, rare coins and stamps, exotic cars, rare wine, or if you're going to just do alternatives such as real estate, oil and gas, currencies, etc., you need to pick and decide. But I think you need to have a level head about you and recognize, as he said, that it is a riskier asset class inherently due to the nature of the assets you're dealing with.
That's a great point. I've seen the illustrations where you take a traditional 60-40 stock bond portfolio and then compare it to 60-39, add 1% Bitcoin in there, and depending on the time period, it can make a significant difference.
Well, let's also agree, and I'm one of the guys who creates charts like that, but let's keep in mind that those are historic charts based on past, and we all know that past performance doesn't guarantee future results. To date, Bitcoin is up 40 million% since inception.
That's why it makes a difference.
That's never going to happen again. So we need to look at it with a very different lens and a different perspective. I believe that the non-correlation element of crypto is as strong an investment thesis as the investment appreciation potential. The one thing I'll differ a little bit with David on, and it's only a little bit difference, David is making a valid point that crypto is hard to value because it doesn't generate cash flows. That is becoming less and less true. Today, in the world of proof of stake blockchains, most predominantly Ethereum, staking is a predictable revenue stream. And that is dramatically helping to provide a new evolution in the world of crypto, whereas you used to be based on only buyers and sellers, and what the market will demand. Now we're seeing genuine cash flows as a result of the new technological innovations, such as from staking. And that is why it's worth a revised look from folks. But aside from that little nit, I'm in full agreement with everything David said.
If I can bring it back to tangible assets for a moment, Gary, because you do a lot of macro research, can you talk about the current macro backdrop? In what environments are tangible assets like gold, precious metals, art, and other things most attractive?
Well, so for gold and Bitcoin, this is a phenomenal environment for it. Rick just made an interesting point. He said, we don't know what the future holds. In this circumstance, I think he's half right. And what I mean by that is I don't know where the dollar price of Bitcoin or the dollar price of gold will be in a year or in 5 years or in 10 years. But I do know that the purchasing power of the dollar will be lower once we get out a year or 5 years or 10 years later.
That's a good point, David. Gary. That's a good point.
Thanks. So for that reason, my personal allocation to these assets is far above what you guys are recommending. But in fairness, I'm running my own portfolio, and that's a very different situation. But the dollar is being debased like all fiat currencies. And the only reason it's not worse or doesn't seem to be worse is other countries are debasing faster. And, you know, when people talk about we have a strong dollar, this is something I've been talking about for 2 years. You know, you see all these people saying, well, the dollar is very strong because they're looking at DXY. That's the dollar index against other currencies, other fiat currencies. And the issue is, yeah, that's 100% true if you're a foreign exchange trader and you want to buy euros or yen or, you know, sell them against the dollar. And we've had higher interest rates. And so the dollar has been strong. But if you're an American citizen and you own dollars and you want to do things like, I don't know, buy food or fuel or pay the rent or buy a home, the dollar is not strong. It's very weak. And for that reason, we've seen strength in these other assets like gold and Bitcoin. So this is when you are in an inflationary environment and we have Congress spending like crazy and the Treasury Department monetizing this, they're undoing everything that Powell and the Fed are trying to do. We're going to see further declines in the purchasing power of the dollar. And so right now is a great time to be involved in all that. I would add one other thing too, that there's political risk here. And I think it's really important to have some assets outside of the system and not only not subject to inflation or debasement, but not subject to confiscation, right? And let's just take a minute and think, you know, a year or so ago, the Canadian truckers, and for everyone who's listening to this, I don't care which side of the aisle you're on, right? Whether you're on the left or the right, whether you agreed with the truckers or disagreed, to me, there's something very frightening about the fact that the Canadian government froze the assets and bank accounts of people who were involved in a peaceful protest. And Canada's laws are different than our laws here in the United States, but this is important. And, you know, whether you want to own physical gold or Bitcoin and self-custody it and have it, you know, in a hard wallet or a software wallet, whatever you want to do, I think there's a huge advantage and a huge safety element to having some assets outside the system that can't be confiscated by the government.
I agree with Gary there in terms of the best environment. We've already seen the best macro environment for gold, crypto, art. That's when you have the Treasury combined with the Federal Reserve creating an additional $6 trillion, where the money supply went from 15 trillion to 21 trillion in a matter of 18 months. And that blew up every single asset, including watches, something you've talked about on this show. And so that's important. The second thing, though, is if you're going to invest in Bitcoin, if you're going to invest in gold, at least go through the exercise of buying a gold coin, of getting a crypto wallet. You know, certainly not all the exposure. It's easier with the Bitcoin ETFs, but just going through that process. The first time you hold gold and realize, wow, this is incredibly heavy. I see why people get it. Or the first time you're walking around with a wallet and you're thinking, I have this Bitcoin or this Ethereum in the wallet and I can go anywhere in the world and spend it and nobody's going to bother me about that. And so use the tools, don't just invest in it, but figure out what all the hype is by actually holding gold, using crypto, staking Ethereum, as Rick mentioned. That's how you learn about asset classes and really understand what's going on underneath the hood.
David, that's a great point. And I know for me, that moment was the first time I took Bitcoin off of one of the crypto exchanges and moved it to my own self-custody and physically held the device that my crypto was on, that my Bitcoin was on. And I'm a huge believer, like you, that there's a use case for this. And in fact, I'm heading to El Salvador next month because I want to go see it. Their whole society, their economy, their crime rate has been completely transformed. And, I don't think it's a coincidence that it happened at the same time they went on the Bitcoin standard. I want to go see it. I want to talk to hotel workers, taxi drivers, the people who make coffee, waiters, just whoever's there, and find out what's happened in their lives, because this does change people's lives. And you're right, when you physically hold it, when you exercise it, when you interact with it, you take it from this esoteric, what's it worth in dollars, to, hey, this has value to me. It's a real thing.
On my upcoming podcast in a few weeks, I'm interviewing Miss El Salvador and her journey down the crypto rabbit hole, and how she's building her whole career around crypto these days, based on, as you say, what is happening in El Salvador with crypto.
I'll be tuning into that one.
If you want to make an introduction, I'm going to be there next month. I'd be happy to buy her a Bitcoin coffee.
The Inspired Money matchmaking episode. We will go to segment 3 and talk more about crypto and blockchain.
Let's explore the enduring allure of tangible investments, art and precious metals. This segment highlights their significance in modern investment strategies. The precious metals market, projected to reach $403 billion by 2028, remains a staple for investors. These assets, including gold and silver, are not just commodities, but safe havens during economic fluctuations, often acting as inflation hedges. Meanwhile, the art market, particularly in contemporary and digital art, is flourishing. Art transcends aesthetic appeal, emerging as a financial asset influenced by rarity and artist reputation. Both art and precious metals offer diversification, moving independently of traditional markets and adding security to investment portfolios. However, they require careful consideration of liquidity, valuation, and additional costs like storage. As we delve into these tangible assets, we recognize their crucial role in diversified portfolios, symbolizing the lasting value of physical assets in a digital world.
Now that I see it, I'm getting confused with which segments we're doing, because I thought that we were switching them around. So that's on me. So what do you guys want to talk about? Are we still talking about Bitcoin and blockchain, or do we want to talk about, let's go, let the conversation go naturally. We were talking about crypto and blockchain. So Rick, you mentioned that you're excited for the spot Bitcoin ETFs, and you wrote your book a little while ago. It's been a little bit, right?
It came out in 2021, The Truth About Crypto. Mm-hmm.
Yeah. So The Truth About Crypto, it's been a little while. Things change really quickly in the digital currency market. Can you review really quickly, like, some of the core principles that you emphasize for investors in your book?
Well, the real key is to understand that this is a brand new technology. It has nothing in common with any of the asset classes we've grown up with. It has nothing in common with stocks or bonds or real estate or oil and even gold and precious metals. It is totally new and different, and therefore requires a new and genuine look at it to understand the underlying technology of blockchain, which is software. That's the difference between this and fads. This is a technology that has business application, and Bitcoin is the first use case of blockchain technology, but it doesn't stop there. It merely started there. So people need to simply understand how this works. They need to also understand the risks. They need to understand how you fit it into a diversified portfolio. You need to understand the technology the same way people need to understand how remote controls work to access their home audio video gear. This doesn't come naturally because it's something that we're not familiar with. So I believe that it's an exciting technological innovation because blockchain technology allows businesses to operate faster, cheaper, safer than traditional ledger technology has allowed businesses to do. And it's going to be able to help companies save massive amounts of money and by extension, increase profits because of the nature of the technology, it also allows for inclusion. People who currently don't earn enough money to open a bank account, and we're talking about 1 billion people on the planet who live in abject poverty, according to the UN. These folks don't have enough money to open a bank account, or they don't live anywhere near one. Well, now, thanks to crypto, you don't need a bank. All you need is a cell phone. You don't even need a smartphone. Just an ordinary cell phone is all you need to be able to obtain a wallet, a digital wallet, and buy Bitcoin. And you can transfer it to anybody, anytime, 24/7, 365, virtually instantaneously and free, compared to the global banking system, where if you wanted to move money from one country to another, it can take 5 days and cost 6.5%, 20% in sub-Saharan Africa. So this is a revolutionary technology that is really changing the nature of finance, which is why we're really very excited about it. But it is new and different, and a lot of it is unknown. We don't know what the regulations are in a lot of countries. We don't have the treaties in place yet. A lot of tax rules are yet to be written. This is, we're kind of like 1920s automobiles. Back in the 1920s, there were 200 automobile manufacturers in the US. Today, there's 4. So we don't know who the survivors are going to be. And at the same time, in the 1920s, cars were incredibly dangerous. They didn't have brake lights. They didn't have windshield wipers. They didn't have seatbelts. And we didn't have stop signs, traffic lights, and speed limits. So the first thing that we had happen after Henry Ford rolled cars off the assembly line is that we had car accidents. It took a while for governments to create the rules of the road that ultimately made cars so much safer today than they were 100 years ago. It's kind of where we're at with crypto. It's new, it's exciting, but it's a little bit dangerous. And that's why you need to have a calm, cool head about yourself when dealing with it. You need to limit the exposure so that you're not harming yourself financially if you do something wrong. You need to learn how to avoid the scams and the frauds, which are unfortunately still prevalent. I am really excited about the Bitcoin ETFs, predominantly because for the ordinary, average, everyday consumer and investor, the ETFs provide a familiar, comfortable, and much safer way to engage in this asset class than if they try to do it on their own, surfing the internet to try to get a digital wallet, dealing with private keys from an offshore unknown entity that could end up being the next FTX. So I like the ETFs largely because they have simplified the situation, they have dramatically increased the safety, and they have made it easier for people as their first step down into that rabbit hole. But I think once people start to get engaged via these ETFs, they're not going to stop there. They're going to discover the problems and limitations of the ETFs. Number one, it's only Bitcoin. It doesn't give you access to any of the other crypto environment, meaning you're not getting diversification. Second, it's a security, which means it only trades when the stock market is open for business, and that's only weekdays except for holidays. Bitcoin's price moves so dramatically, you miss out any opportunity if there's volatility at nights or on weekends or holidays. And you also have the annual fees of the ETFs, which you don't have when you buy it necessarily on your own. So there are issues, limitations, but I think it's a great initial way for people to get engaged. And this is going to be the door opener that's going to result in millions, billions of people participating in crypto for the very first time. So I think it's exciting, but I don't want us to get ahead of ourselves. I don't want people to put themselves in danger of risking their personal financial security over this. But I think we can effectively achieve a proper, comfortable approach for engagement in this space.
Gary, besides sharing a drink with Miss El Salvador, what do you hope to learn through your visit? And as a research guy, what are the implications of a government making the investment in buying Bitcoin?
Well, so first of all, I think there's a huge advantage to when you go to these places talking to the people. And I travel a lot. I spend most of my winter living in different countries, and you learn a lot about their finances, their economy, their lives. They'll tell you all kinds of personal things. The only thing you need to do is ask them the question in a non-judgmental way, right? You just want to convey, I'm interested in getting to know you. I want to understand, what you're dealing with and what your life is like. And people will open up and they'll tell you an enormous amount. And the thing that I think is really interesting for me, the case for Bitcoin is very clear, which is the one that I made before, in which David, I think, illustrated perfectly, saying, hey, $6 trillion of fiat currency creation, right? We have a dollar that's declining in value in terms of purchasing power. And so that's the thesis there. But when you take a look at El Salvador, they've had societal changes and hard money, meaning money that isn't easily replicated or debased, is correlated with low crime rate, high rates of investment, beautiful art, fantastic architecture, societies that work well, are low crime, and invest for a future. Societies with high inflation, with soft currency, where your money can be debased and the value of it disappears. You have ugly art, ugly infrastructure, ugly architecture. You have high crime. People don't invest. They're incentivized to have a very short time horizon on everything and to simply spend their money as soon as they get it. Because how do you save in Argentinian pesos? You can't. You lose 10% of your value every month. So how do you do things like save for a house or save for an education? These things aren't possible in bad currencies. So I actually believe that fiscal policy has a massive impact on people's lives. But if you really want to find out, you need to go there and talk to the people and engage with them and find out what their lives are like and ask them those questions.
Gary's raising a really important point that I think American investors too often forget, which is the fact that Bitcoin is a global asset. One of the most common questions that I get when I do training sessions for advisors on this subject, the question I get is, why do we need Bitcoin? And that's a kind of a fair question if you're an affluent American. I mean, we have a banking system in this country that, although it's really easy to criticize it, we all love to hate it, it works pretty well. I get my paycheck direct deposited to my bank. I can access it through an ATM or my debit card pretty easily. I don't have to worry for most cases that the bank's going to suddenly get shut down. And even if it does, I got FDIC to protect me. The banking system pretty much works okay. But if you're in countries like Argentina, Zimbabwe, and the list goes on, where people get paid in current local currency cash, and the first thing they do is run to the grocer to buy bread before the currency gets debased by 50%, and they can only buy half as much bread tomorrow as they could buy today. We have to remember that the reason there's so much excitement about this is not necessarily affluent Americans who can regard Bitcoin as an option, but for an awful lot of people around the world, I'm talking billions of people, this is an essential savior to their financial security.
David, I think you had something to add earlier.
Well, I mean, just to Ric's point, we don't necessarily talk about, buying the Japanese yen or some other fiat currency to make money. And I think there's the difference between the use case for Bitcoin, which, right now, money needs to be convenient and it needs to hold its value. On that front, Bitcoin is neither. I mean, a couple of years ago, I bought a watch at a jeweler using Bitcoin. It took 20 minutes because I had to get the invoice, send the Bitcoin to Coinbase. Then after it was verified, then I was able to take the watch out, but then I had to pay capital gains tax on the Bitcoin I sold in order to purchase the watch. And so from that aspect, if the monetary system is broken somewhere, like in Venezuela or Argentina, this is sort of good enough, Bitcoin, but it's by no means sort of as easy as other fiat currencies, because at this point, we don't have the additional layers on top of it. So Bitcoin itself, the blockchain, that's sort of the base layer. That's sort of the equivalent of just having money at the Federal Reserve, which as individuals, we can't do. But on top of that, there's secondary layers. And in terms of debit cards through the banking system or credit cards or Venmo. And that's where there's some excitement where Bitcoin or Ethereum, can be helpful if once we get these additional layers, because right now we're way down here sort of focusing on the base layer, and it is incredibly inconvenient to use Bitcoin for what it was designed for as a way to actually buy things or use it. At this point, it is effectively digital gold because nobody just as we don't pay for gold because things for gold, because one, it's inconvenient because it's so dang heavy. The same, that's kind of where Bitcoin is now, unless you're somewhere where the fiat system isn't working. And so we do want those additional layers, and we want the regulation to support it. When you think about FTX, when you think about BlockFi, where these individuals running these businesses essentially stole the client's money. They commingled the assets and they didn't act like a true broker, a traditional financial brokers are supposed to do. And so the additional regulation is also another layer that's important so that people have trust in these type of assets. And that's something that's not there yet, but hopefully coming along.
I think David makes an excellent point here. And the way I might reframe it is to say there are trade-offs. And so the negative is certainly there's no 800 number to call, right? You can't call the manager. There's nobody to help you if you have a problem. You need to actually do research, right? It's if you want to own Bitcoin and use Bitcoin, you need to do research. There's no Bitcoin help desk to call for that. And that does make things difficult. And it does mean that there's a learning curve. But, just like we all learn to balance our checkbook and use banking apps on our phones and use our ATM cards, this is knowledge that can be acquired, but it does take effort. But here's the other side of it. The other side of it is that is money or an asset that can't be confiscated or debased by bad policy. It is insurance against bad government decisions. And, we think about it in terms of, US policy, but, you guys were just making this fantastic point that, hey, there are parts of the world where your currency really does get debased. And I lived in Buenos Aires for part of last winter, and you'd see as soon as people would get paid, they were instantly converting their currency. They spent an enormous amount of time and energy and resources trying to protect the value of what they own. You can't rent an apartment in Buenos Aires. I spoke to people there, and you should see what it's like. You can't buy a house. When you actually understand the restrictions there as a result of bad government policy, you understand it is worthwhile to learn to use these alternative assets, because to have something outside the system provides you insurance against bad government decisions.
Well, I think it's notable that we have three very smart investors here, all paying very close attention to cryptocurrencies and to blockchain. I want to get back on track now. I'm going to show segment 4, and we will actually talk about the right topic.
In modern investing, private equity and hedge funds stand as sophisticated strategies for the discerning investor. This segment delves into these dynamic investment vehicles, exploring their potential in today's economic landscape. Private equity, encompassing venture capital, growth equity, and buyouts, offer direct investment opportunities into the burgeoning world of private companies. From nurturing innovative startups to transforming established enterprises, private equity is reshaping industries. Hedge funds, known for their diverse strategies, including equity-related and event-driven approaches, seek to generate active returns. They adapt swiftly to economic changes, increasingly focused on digital transformation and sustainable practices. These investment forms are not without their complexities. They typically present a higher risk-return profile and require thorough due diligence. Access is often limited to accredited investors, and they come with longer lockup periods, demanding a strategic approach. As we explore these sophisticated strategies, we uncover their role in offering enhanced returns and diversification in modern investment portfolios, highlighting their appeal to investors seeking to go beyond traditional asset classes.
So Gary, hedge funds, this is your area. The term hedge fund is so broad. It encompasses so many different strategies. I was just wondering, do you view it as high risk, high return, or is it conservative, seeking an absolute return?
So the last time I took a look at the industry, it was a few years ago. And at the time, there were something like 9,000 hedge funds. I don't know what that number is now. It's probably lower at the moment. But there were 9,000 examples. So some of them were high risk, high return. Others were, sector specific. Others were ultra hedged. leverage, no leverage. There are so many different strategies. And some of them provide, they do a really good, boring job at earning, slow and steady returns. So I don't know. I think, the sense that it was high risk, high return sort of came from the early days of the business, where you had, guys like, Michael Steinhardt or Leon Cooperman, who, they would swing hard and turn out great returns. And, they were larger than life characters. And I think that's where that came from. And, they built up big names for themselves. Certainly the guys at Tiger have done extremely well in some concentrated portfolios with phenomenal research. But the industry really diversified over the following decades. And with 9,000 hedge funds, or however many it is now, I don't know that characterization is still broadly applied.
I think probably a better way to describe hedge funds at this point is high fees, mediocre returns. I mean, if you're talking about individual investors, there are some brilliant hedge fund managers out there. At my old firm, we invested with some of them. We ran some hedge fund of funds. And I can tell you, as a business that was based on trying to research hedge funds and find those with some type of competitive edge, incredibly difficult. And if you could find them, whether they were willing to take your capital, to actually generate those type of returns, they have to constrain the amount of capital. And so as individual investors, I have no hedge fund exposure in my portfolio because I can't access the top tier hedge funds.
But
Private
David,
capital
isn't
or
that
private equity is a little easier, but it's not easy to get access.
isn't that an inevitability, David, that if you're going to have 9,000 of these outfits, we're not in Lake Wobegon, right? They all can't be above average. So they all do charge high fees. So you're going to get that no matter which one you pick. 2 and 20 fee schedules are common. But clearly mediocrity by strict definition is exactly what you have to expect. So yeah, you're absolutely right about that observation. And it's an interesting conflict of interest, isn't it, that you're pointing out that their goal is to manage as much money as possible, to collect as much new money and to have that money grow as much as possible, because that's how their fees are based. So they want to attract as many investor dollars, but the more dollars they attract, the harder it is for them to pick the few winners that are going to allow them to have outsized returns, to brag that they're better than all the others. So it's a challenging world, and I'm not at all surprised to hear you say that you're not investing in many of them, if at all, because it's so difficult to find the good ones. And even when you find them, was it Groucho Marx said, I'd never join a club that would have me as a member. I would never have access to a club I'd want to be a member of, is kind of what you're saying. And it's unfortunately often too true.
I think over the last decade, there have been two changes that have made it very difficult for hedge funds to continue earning the kinds of high returns they had in the earlier days. One is on the long side. The indexes are now concentrated, right? The top 5 or 6 stocks in the S&P 500 make up close to 30% of the index and pretty much all of their returns. And that makes it really difficult as a stock picker to outperform. The other thing is on the short side, and this is the part of the market that most people don't think about. But, I used to not just generate alpha, we used to make money shorting stocks. And the issue is, over the last couple of decades, there's been so much of a flow toward index funds and people indexing that basically the more overvalued a stock is, the larger a part of the index they are. And as money flows into those index funds, the more money actually flows into these stocks that you would be shorting because they're overvalued or there's some sort of problem. And so when you have these enormous money flows sloshing into like the S&P 500 index or the NASDAQ, it makes it really difficult to short stocks that are going to be going up just on non-discretionary buying. And I think that's something that the hedge fund business was very slow in responding to. Both those changes, the business should have responded sooner and found more innovative ways to adapt to what was a changing environment.
And let me pile on to that point, Gary. You're absolutely right. But one of the reasons that the indexing has grown so popular and why those asset flows continue no matter what's happening in the economy is because most of the asset flows into the public stock world are coming from retirement accounts. most significantly, 401ks. People are getting their paychecks every 2 weeks, and every 2 weeks, 1 or 2 or 3% of their paycheck is going into their 401k and going into those stock funds. So whether the market is going up or down, the flows are going in. And so how can you short in an environment where there's constantly buyers all over the place?
The tail is definitely wagging the dog. Let's bring it home with segment 5.
This segment focuses on common mistakes investors make and how to avoid them, ensuring a strategic approach to this diverse investment landscape. One major misstep is investing based on a brand rather than solid data. It's easy to be swayed by well-known names, but thorough research and understanding of the investment are crucial. Another pitfall is chasing the latest trends without considering their alignment with your overall portfolio. It's essential to resist the allure of hot asset classes and focus on how they fit into your investment strategy. Underestimating the unique risks of alternative investments, such as liquidity concerns and market volatility, is another common error. These investments, including real estate, private equity, and digital assets, require a deep understanding of their risk-return profiles. Additionally, investors often overlook the higher fees and expenses associated with these assets, impacting overall returns. To navigate these pitfalls, conduct comprehensive research, understand each investment's risk profile, and ensure a diversified portfolio.
Since David mentioned high fees, mediocre performance when it comes to a lot of hedge funds, and certainly last year was a period where it didn't pay. It was very difficult to manage risk. When you have a magnificent 7 just driving performance, you didn't need to manage risk. Just own the S&P, and it was very difficult to beat the S&P. David, what are the common pitfalls when an investor is considering alternative investments? Like, what should they look at? I mean, it sounds like performance net of fees, but then don't chase performance.
Well, I think I wrote a book a couple years ago called 10 Questions to Master Successful Investing. And one of the questions is understand what's the upside? What is it that drives the return? We talked earlier about the return of something like art or gold. It's because there's no cash flow. It's demand from people wanting to hold it, or institutions. And we've talked about why that's the case. The beauty of stocks or real estate is, particularly stocks, is you get cash flow. I mean, that's the driver. It's that dividend. And is the cash flow growing over time in terms of the earnings growth? And then almost more importantly is how much are investors paying for the cash flow in terms of PE or in terms of the cap rate for real estate. And so for any asset class, as we research, we need to understand what are the downside, but what is underlying the return, so I know what's a reasonable expected return, and then understand who's on the other side of the trade, like who's selling me this asset. And that's why investors have moved to index funds, because the good companies and the bad companies cancel each other out, and it's driven by the cash flow growth. And then the key is to make sure we're diversified and not completely focused on US, but have investments outside of the US. Because I mean, there's very few people like Gary that can run 5 holdings successfully. Most of us can't do that. We don't have that type of knowledge. And so as individual investors, we want to broaden out what is it that drives a return, and then add a little bit of spice in some of the things that we talked about today. But mostly we should be income focused, cash flow focused, and how that cash flow grows over time. So we're compounding our returns year in and year out.
Rick, you're the futurist among us. What do you see in the future, and how can that inform how we're positioning in alternative investments?
Well, I think that the word for the 21st century is technology. It is innovation, and the innovation is coming at a faster pace than it ever has before. We're seeing the very early stages of the results of this through blockchain that was invented in 2009, AI, which is now generating huge levels of attention through open AI and ChatGPT and the whole aspect of generative AI, we're going to see major leaps and bounds in innovation over the next several decades. And it's already beginning in virtually every aspect of society, of industry, around the world. You need to make sure that your portfolio is constructed for the 21st century. If you are investing in companies, if you have an asset allocation that is modeled on the 20th century, you're going to fail. Even where that would have been successful in the 20th century, it won't succeed in the 21st century. You need to make sure that your investment strategy, your portfolio is designed to fit the world we are living in and the one that we're going to be living in.
And how about you, Gary? What are your thoughts?
First of all, those are both phenomenal answers. Ric's answer that he just gave is a terrific one, and I actually want to come back to that in a second. David was saying a big question is who's on the other side of the trade. And it's a great question to ask, because the question I always ask is, what's the flaw in the narrative, right? What am I missing? What is everyone else missing? And if you don't have an answer to that, it's like the old saw about if you don't know who the sucker is at the poker table, it's you. I think there are two key mistakes that people make, two flaws that are worth pointing out. One of them touches on Ric's point, which is you really do need a 21st century model. And the 20th century model placed too much emphasis on short-term volatility, right? And that came out of the guys at Long-Term Capital Management, and who blew up so spectacularly. I think they said, if it was an event that shouldn't have happened if the universe were 14 times as old as it was, right? We need 14 lifetimes of the universe for this event to happen. And it happened within the first 2 or 3 years. And that should have put an end to the way they viewed things. And I think the reason it didn't is because it was measurable and people like what they can measure. But the truth is, if you're a long-term investor, the short-term volatility really isn't that meaningful, and everybody's focused on it. They say it's the proper measure of risk. It's not. It's permanent loss of capital, particularly if you have the time frame to wait it out. That gives you an enormous advantage, being able to pick your entry and exit points. The second point I'd make is there's too much following. Don't follow everybody else. And, we were just talking a few minutes ago about, how hard it is to be an asset allocator. But a lot of the asset allocators I saw, they would do a lot of work and do a lot of research and maintain these enormous databases. And then what they would do is they would take that work, throw it out, and do what everybody else is doing, because the name of the game is don't be wrong alone. But doing what everybody else is doing doesn't get you good returns. And, listen, all three of us were negative on the performance of the hedge fund business. And I, as somebody who is in that business, I readily acknowledge, the industry didn't shift as quickly as it should have. And as an industry, we have not had a great last, 10, 15 years. But it's easy to blame the hedge funds. One of the things that is worth pointing out is a lot of the asset allocators reward the asset gatherers, right? Instead of looking for great performers with a great process, they'll find those guys and then say, but you're too small. I don't want to invest with you. And they'll invest with everybody else. And so it incentivizes a limited number of managers to continue gathering assets and turn out mediocre performance, because as long as you're big and don't blow up, you're going to make a lot of money. And so I think there are bad incentives and bad behavior on all sides. If you're listening to this and you're making your own investment decisions, figure it out, instead of following everybody else into the same assets or the same managers. Find the people who have a good process and who are thoughtful.
Well, I want to thank our panelists for joining me for this episode and really giving us a lot to think about. There are a diverse range of assets that make up alternatives. It can be real estate, it can be art, it can be cryptocurrencies, it can be NFTs, which we didn't even really talk about, hedge funds, private equity. And I think the takeaway is just, it's worth taking a look to do your research, to invest in things that you can understand, and then allocate a small portion of your portfolio to that, because it can give you some protection against volatility. It can give you long-term potential growth. and just look at the world, I think, as an investor. Look at the tangible investments, look at digital investments, look at your stocks and bonds, and really be an investor. And I love the idea of, yeah, it has to be forward looking and not backward looking. You need to own a 21st century portfolio in the 21st century. So thank you to our panelists once again. You can find Ric Edelman at the TAYF.com. Is that where you want to send people, Ric?
If that works, The Truth About Your Future, that's my daily podcast, or easier, dacfp.com, dacfp.com.
Thank you. David Stein, you can find at moneyfortherestofus.com. Fantastic podcast and website. And Gary Brode, deepknowledgeinvesting.com. Thank you, everybody, for joining us for this episode. And I hope to see you next week, Wednesday, January 31st at 6 p.m. Episode 21, we're talking about the art of negotiation, mastering the skill of financial success. It's something that I think can bring tremendous value to your life, but it's something that many of us don't really enjoy as Americans. So we're going to talk about negotiation and hopefully pick up some skills that we can apply to our daily lives. Thanks for joining me, and I hope to see you next week. In the meantime, do something that scares you, because that's where the magic happens.